Well, to dig in deeper to the latest consumer inflation data and what this means for the Fed, we've got Juneau, Bank of America Securities U.S. economist, joining us now. Stephen, good to talk to you. You heard Jen kind of breaking down some of these expectations there, potentially with the hotter than expected print today, moving the rate cut maybe to June. What's your read on the data today, and what's the one thing that stood out to you?
Yeah, so we actually shifted our Fed call from March to June after the January meeting. I think, what we heard from the chair in the January meeting is that the Fed's not ready yet. They want to see greater confidence. Today's report, I think if there's one takeaway, is that it wasn't good enough for the Fed. It wasn't the confidence they wanted to see. When you look at the details of the report, where they want to see confidence is really on the services side of inflation. Services inflation, core services, actually accelerated to about 0.7% month over month. Core goods deflation persisted. It was all used car price story. So really the components of inflation are not what the Fed wants to see, but they do have a lot more data that they're going to get before the June meeting. This is just one of 5 reports that they'll get before June. So there's still time for that.
Yeah, and to Jen's point, the Fed doesn't just look at one data set, but you look at where the market reaction is today. Certainly, it feels like there's been a lot of jitters around trying to sort out the timing of when that rate cutting cycle will begin. Even though this came in higher than expected, does this change anything for you on where you think that timing of that cut is?
I don't think so on the timing, because June is probably enough time for them to get the data on hand. Inflation and the path towards 2% was never always going to be a smooth ride. We saw very good progress last year, but that wasn't necessarily guaranteed to continue. It wasn't what we were forecasting. We thought this year would be more about sticky services inflation. That's what we're seeing. And we thought it would be about core goods deflation diminishing over time, because we saw a lot of the supply side factors, the supply chains unclogging last year, really fade last year, really impact the data last year. And that's not necessarily going to affect the data as much this year because they're just not as strong of effects. So on that, I don't think it really affects the timing yet. If we see that this is a new trend in terms of this acceleration isn't just a one-off in January, we start to run at 0.4, 0.3% on a sustainable basis on core CPI inflation over the next few prints, then it could affect the timing of the Fed's cutting cycle. And that would also be in conjunction with the fact that activity, which started off the year, appears to be very resilient, very robust. So we're not really seeing signs that growth is slowing down. We obviously added a ton of jobs in January. Retail sales will get later this week, so that can influence the Fed's thought process, because it's not just inflation that matters. It's also activity when they're thinking about where they want or how they want to set policy and when they want to start that cutting cycle.
Stephen, you mentioned services inflation, 5.4% increase year on year. If you compare it to the previous month, it's still up 0.7%. Why has that proven to be so sticky?
So a big reason is actually shelter. Shelter inflation you saw accelerate as well. That's a big driver behind that. When you look at core CPI, when you look at core services, it's really driven by shelter. And one thing to note there is that shelter inflation kind of lags asking rent inflation. So what's actually happening today, if you're looking to get a new apartment, looking to take on a rent, what we've seen in terms of actual rent inflation is that in terms of asking rent inflation is that there has been a moderation, and that should ultimately feed through to shelter inflation, but it hasn't yet. And that's something that, we and the Fed are expecting to see over the course of this year. So we'll see what happens. Obviously, it hasn't happened yet, but we'll see how shelter inflation really evolves.
Any one risk here that you think maybe investors are overlooking? You look across where we saw some of these gains, it does still feel like we're moving in the right direction, maybe not at the rate that the Fed would like. What are you going to be watching in the next several weeks between now and that March meeting?
So I think what we'll be watching is the activity data. So we'll get retail sales. We'll be paying close attention to the PCE data, the PCE inflation data, which really is what the Fed targets, not CPI data. And PCE inflation is running a lot closer to the Fed's 2% target. We think the read through this month will also show a bit more of an acceleration in PCE inflation. But that's something that we'll be watching closely. And obviously, it's the activity data, it's the jobs report. Was the January acceleration in job growth, is that sticky? Is that persistent? If it is, then you obviously have greater upside risk to growth, greater fears of demand-driven inflation if you're a member of the Fed when you're trying to think about how things will evolve. And that's what we'll be watching closely. It's just those big reports, employment, CPI, retail sales. Those are kind of the things we'll be watching to see how not just inflation is progressing, but also how activity is progressing.
Stephen Juneau, Bank of America Securities U.S. economist. Good to talk to you today. Appreciate the time.